Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the earlier session, we discussed about some of the basic concepts of investment decision making and what is the importance of investment decision making process and what are the steps involved in that also we discussed in the earlier session. And as we already discussed, generally from an examination perspective, the question will be given either with the cash flows already, or sometimes we have to calculate the cash flows. Most of the cases the second thing happens, which means we need to determine the cash flows, and that will be one of the first steps before we apply any kind of technique of capital budgeting. But let me once again reiterate that application of the techniques of capital budgeting computational wise is a very clerical process, though we have to do that, just computations. But the crux of this chapter can be called as this estimation of cash flows. Of course, we cannot estimate from air, data will be given. From that, we have to find out what will be the cash flows associated with this particular decision. And naturally, these decisions are long-term decisions, which means cash flows also will occur in future. So, what are the two aspects when we observe the cash flows? Mainly will be one, naturally the amount of cash flow, amount, of course that will be requiring some computations, and more than this, the direction of cash flow. So amount and direction have to be observed. Direction in the sense, is it an inflow or outflow? And another important aspect to be observed definitely is the timing of cash flows. When are they happening? These are the two aspects. If we can keep in mind always, we will be able to estimate the cash flows perfectly. Of course, we need to know some other intricacies of this development of or estimation of cash flows. That's what we will discuss in the current session. So how to estimate the project cash flows is a very important step. And like any other decision making process, here also we have to consider incremental cash flows only from a particular investment which is likely to result if the project is accepted. So only the additional costs and additional benefits which might happen because of this investment decision will have to be considered. When we say investment decision, it could be a project or purchasing of an asset, whatever it is. The capital budgeting and investment decisions which are taken while considering the future cash flows. And the point here to notice, these are to be incremental cash flows or the additional costs and additional benefits. So why this becomes important is we should understand relevance and irrelevance of some of the items which even in short-term decision making and costing also we generally have an idea about. Like for example, sunk costs are irrelevant. Already those are incurred earlier, done. Now they are not relevant for decision making process. They have been incurred, they were incurred earlier, done. That's all. We don't have to consider them for decision making process, so they are irrelevant. This relevancy and irrelevancy has to be noted. So the irrelevant cash flows are irrelevant costs are sunk costs, definitely. Like that opportunity costs, if at all we say, they are relevant. Though they may not be really incurred, they are relevant. So the types of costs and cost means basically also they will be cash flows, outflows, which have to be considered, which should not be considered is an important aspect. While doing so, one of the points to be noted is always we should look at incremental costs and benefits that might result from this particular decision, not the things which are already there. So if something is already there, already the company is making some profit, some money, some cash flows are there, That is different. That has nothing to do with this decision. This decision results in what type of incremental cash flows. They only have to be considered. Sunk costs should be ignored. Opportunity costs, if any, should be definitely considered. So that is the point here to be noted. And as we already discussed, timing of the cash flows is very, very important. That has to be identified very carefully. And sometimes that may not match with the period of profit. That is another crucial point. While understanding the estimation of cash flows, profit is different, cash flows are different. Both are not same. Profit is an accounting item. Cash flow is reality. So in corporate terms, usually it's called profit is a myth, cash is reality. So what is the relevant thing here when we are doing the investment decision making and applying the capital budgeting techniques? Is it profit or cash flows? It is cash flows. Of course, only one technique uses accounting profits. That technique is ARR. That is a reason why it is called accounting rate of return or average rate of return, popularly called accounting rate of return. Only in that technique we use profits, accounting profits. Whereas in all the other techniques, whether it is payback period, discounted payback period, NPV, IRR, profitability index, MIRR, whatever they are, all the other techniques, whether DCF techniques or non-DCF techniques, but the information that has to be processed, the core input for our analysis or application of the technique will be cash flows, but not profits. Then a question comes, what is the difference between them? Will there be any difference? Of course, there will be a lot of difference. Certain times, we may have accounting items which are not resulting in any cash flow as it is. What is that major item which is a non-cash item? Simple, that is depreciation. So this is the very crucial item also in understanding the estimation of cash flows. Depreciation plays a crucial role. Why is that? Because it is an expenditure, definitely yes, and this is a tax deductible expenditure. It is tax deductible expenditure. That means it has tax impact. That is real. But expenditure of depreciation is not having any cash outflow. It is a non-cash tax deductible expenditure which is taken into consideration in the computation of accounting profits. But is it resulting in any real cash outflow? Definitely not. That means there will be difference between accounting profits and cash flows because of depreciation. To be very specific, because of the tax impact of depreciation. Depreciation anyway is not a cash flow. You can just simply ignore that. Can we do that? No. Why? Though depreciation is not a cash flow, it has a tax impact. What kind of tax impact? It has a benefit. It has a tax benefit that is there. So in other words, let us say depreciation as an expenditure is there, total depreciation, but there is a benefit also there in the form of tax deductibility of that. So what will be the actual net of these two things is, we can simply call that as depreciation tax benefit. That is one item which can be adjusted separately, or profits can be adjusted with depreciation so that we can get cash flows. For simple understanding purposes, let us say we have normal profits. For general computation of profits, depending upon the data, normally we can start like this. Okay sir, sales is there, variable cost is there, so contribution is there. From that, fixed costs are deducted other than depreciation. So what we get is, let us say, earnings before interest, tax, depreciation and amortization. That is called EBITDA. We don't need to use this word, only for understanding purposes. Operating profit we can call before deducting depreciation. But depreciation is there. Accounting wise it is there. So depreciation, once you deduct it, we have this earnings before interest and tax. Then interest will be deducted. Then we have earnings before tax. Then tax will be deducted. Then we'll have earnings or profit after tax. This is a normal way of calculating profit. Normally, this has directly nothing to do with our estimation of cash flows. But the point is, if all these details are given, we can simply calculate it according to our requirement. But sometimes directly this may be given, profit before depreciation may be given, sometimes profit after depreciation may be given. So if we say there is a profit which is given after depreciation, is it a real cash flow? No, it is not. So what will be the effective way of adjusting the tax impact of the depreciation if the data is available? Let us put it this way. The profit before depreciation, whatever it is, if you take and if you deduct depreciation, we will get profit after depreciation. Okay. Then naturally tax has to be deducted. Forget about interest for the time being. Why is that? I will explain later. Interest has to be ignored in the capital budgeting. It has to be. While taking investment decisions, what is the financing cost should be ignored. So why is that? We will understand it later definitely. But right now, just remember, interest should be ignored. Forget about it. Leave it aside. Just to focus on depreciation and tax. Depreciation and tax. So profit before depreciation is there. Deduct depreciation, you got profit after depreciation. Deduct tax, you got profit after tax. Now, this is not cash flow. So what we have to do here is, we have to add back depreciation so that we get cash flows. Simple. So this is accounting profit. In order to get the real cash flows, we have to add back depreciation. Why we are adding back depreciation here after deducting it here is because depreciation is not a cash expenditure. So adding back depreciation is one way of calculating cash flows. But adding back where? This is where the issue comes. People will only think add, deduct. No, that's the problem. Adding back where? After tax profits we have to add to. On the contrary, let us say we have the profit before depreciation. Directly we can have the tax benefit on depreciation also added to that so that we can get the same amount. So for understanding purposes, let us just take an example. Say profit before depreciation is 1 lakh. Say depreciation is 20,000. So profit after depreciation is 80,000. Say tax rate is, for simplicity purposes, say 20%. So 20% means 16,000. So profit after tax is 64,000. Now in order to get cash flows, we have to add back depreciation, we know that. So the actual cash flows are going to be 84,000, not 64,000. Profit is 64,000, that is accounting profit. Actual cash flow is 84,000. So that is the point here to be noted. For computation of cash flows, this is how we have to do. Of course, depending upon the data that is given. But logic, we have to understand what are we adding to. If you add the depreciation to the profit after tax, then we get cash flows. Alternatively, can we simply do like this? Anyway, this 1 lakh is there, which is the profit before depreciation, we can say. And the profit after depreciation is this 80,000. 80,000. In order to get the cash flows, instead of deducting the tax first, then adding back depreciation, that is one way. This is more popular also and easy also. Instead of that, we can just add tax benefit on depreciation. What is the tax benefit on depreciation? Tax benefit is how much here? 20% tax rate we have taken. 20% on 20,000 is how much? That is 4,000. So there also we have the same type of answer, that is 84,000. Either way it can be done, but as I said, in general, the first way is followed, wherein we have profit before depreciation, deduct depreciation, you get profit after depreciation, deduct tax, you get profit after tax, then you add back depreciation, you get cash flows. This is the way of computing the cash flows if this all data is given. But again, that is one of the core aspects of building the cash flows. But there may be a lot of other considerations. We cannot have a specific list of things which will be there. Anything, whatever is given in the question as data available, that has to be used. But what we should be focusing on, we should be focusing definitely on the direction of them. So whether it is a cash inflow or outflow, that has to be definitely looked at. Costs are naturally outflows, benefits are inflows, simple. That is the commonsensical thing we should observe from the data that is given to us in the question. And of course, one of the other things generally which is also part of the overall analysis is the life of the project. Whatever the decision we are taking, buying an asset or something else, whatever that is, there is a time period attached to that. 4 years, 5 years, 8 years, whatever it is, that has to be identified. We don't have to separately look at it because it will be given in the question anyway. That is not going to be a very complicated thing for problem solving. In real life, there are so many points which have to be taken into consideration because longer the life, there is a possibility of technological obsolescence. This type of technology may become outdated in future, we don't know. Physical deterioration may happen and there may be a decline in demand for such kind of products in the future. So these are all practical things in real life. We don't have to worry much about it. For us, what is important to note, point is just life of the project has to be also identified. Enough, that's it. Now coming to the computation of cash flows, as we already discussed, the main point here is depreciation. Depreciation is a core aspect while computing the cash flows. Why is that? Because it acts as a tax shield. So depreciation tax shield or depreciation tax benefit also is another word that is used. That way also it can be calculated. So normally, imagine if this situation is there without depreciation and there is one situation with depreciation. Of course, there is no general way of having anything without depreciation, just for understanding purposes. Let us say the sales are there. This is only just an example. Sales are there, same sales, cost of goods sold same. This is the profit, let us call it 5 crores. In this first case, no depreciation is charged. In second case, depreciation is charged, which is 1.5. Then profit before tax in this case is only same, but profit before tax here is 3.5. Tax is there, which is 1.5 here, taking 30%. Whatever tax rate given in the question has to be identified carefully. You should not use any of the tax rates that you know from income tax subject. That is completely different. This is completely different. For that matter, for financial management subject, never mix anything that is regulatory which is applicable only to India, unless it is very clearly given in the question. Financial management is an international subject. So we should not apply our all great knowledge of Income Tax Act of India here. That is altogether different. Don't mix that. Same way, should not apply all the concepts of the company law here. No, should not. Same way, tax rates and all will be given in the question, have to be given in the question. If they are not given, a rate can be assumed, that's a different story, but normally it will be given. So here in this case, 30% tax rate, so 1.5 crores is tax here, 1.05 crores is tax here. Profit after tax is this 3.5 and this is 2.45. Now here we don't have to add back depreciation because there is no depreciation in this case. So naturally cash flow is how much? Only 3.5. But if you observe, here we add back depreciation and the profit is, our cash flow is actually 3.95. So the point is, where is this 0.45 coming extra? That cash flow, which is more than this, is coming extra 0.45 crores than when there is no depreciation. What is this difference? Where from this extra 0.45 is coming? That is the depreciation tax shield or the benefit on the depreciation in the form of tax deduction. As I told already, simply it can be calculated by taking depreciation amount, in this case 1.5 crores, and tax rate, that is 30%. So on the 1.5 crores, what is the tax? 30%, 4.45. That is the difference. That is the benefit extra which is being generated only because of depreciation. So when there is no depreciation, the cash flow was only 3.5. When there is depreciation, the cash flow is 3.95. That extra 0.45 is because of depreciation tax shield. So how to calculate that is simple. If at all depreciation tax shield has to be calculated, simply depreciation amount multiplied with 30%. In this case, the whatever it is a tax rate. But computation of cash flows can be done here in this sequence, like profit before depreciation, then deduct depreciation, you will get profit after depreciation but before tax, then deduct tax, then add back depreciation. So adding back depreciation to the profit after tax is one way, or directly adding the depreciation tax shield to the profit before tax is another way. So either way it can be done. But in general, this is the kind of technique, or we show this as a working note so that we'll compute the cash flows in a simpler manner. That is the importance of depreciation while calculating the cash flows. So this 0.45 is the depreciation tax shield, we can call it. That is one of the aspects. Second point, as we already discussed just now, opportunity cost has to be considered or not? Yes, it should be considered. So opportunity costs, if there are any. What is opportunity cost? That is the cost of foregoing a benefit, the next best alternative. Whatever the benefit foregone by choosing the next best alternative is called opportunity cost. If any such thing is there, that is also a relevant cost. It should be considered. There you cannot say, there is no actual cash flow, right? How can we consider? No. For decision making purpose, opportunity costs are considered while estimating the cash outflows, because it is a cost, it is an outflow naturally. And another point is sunk cost. That also just now we discussed. Sunk cost, should it be considered? No. It is irrelevant. Sunk cost is irrelevant for decision making. So what should be done? Simply ignore. Sunk cost should be ignored. It should not be taken into consideration because already it was incurred. Whether you take this decision or not, that is not going to have any impact, right? If you took the decision of going ahead with the project also, that sunk cost is already incurred. That was over. If you take a decision of not going with the project also, there is no difference. Ultimately, the cost which has already been incurred is not going to have any impact on future. So decision making process should ignore that. Classic example of that can be like, for example, somebody wants to start a business, and before starting the business they are doing this investment decision making process, capital budgeting, etc. While doing so, they asked for a consultant or a chartered accountant for preparation of a project report for analyzing this project, whether this project is feasible or not. Sometimes it is called a feasibility study report, viability report, a lot of names are there, project report, whatever it is. Generally, chartered accountants prepare that. Big consulting firms do prepare such kind of reports. Before going ahead with any big decision in the form of investment decisions, long-term decisions, usually companies appoint consultants for preparation of these reports. Let us say, for example, in this case, company has given 1 lakh rupees fees for this consultancy firm which prepared this project report. Should this be considered as a cost of this project? No, it should not be. Why? Because this cost is incurred already. Whether the decision ultimately is to go ahead with the project or not, this 1 lakh you have to pay to consultant anyway. So when you have any cost which anyway had been incurred, which has no impact on the future, that should be simply ignored. That is a point here. That is sunk cost, a very important point. Of course, depreciation is going to be there in every question. Don't even think about having or not having. Depreciation is definitely one of the points which will be there in every question. But opportunity cost, sunk cost may not be there in every question. If they are there, we have to understand what is the treatment. Opportunity cost should be considered because it is relevant for decision making, whereas sunk cost should be ignored because it is irrelevant for decision making. That is a point we have to simply remember while developing these type of cash flows. Depreciation is one of the aspects, anyway we'll be there in almost all the questions. Now another important aspect, another very, very important aspect is working capital requirements. When you have, let us say, invested in a new asset, say you purchased a new plant and machinery, can you use that plant and machinery with the same amount of working capital already what you have? It is not possible, because you need new people to operate it. More and more requirement of consumables may be there for that. Whatever the requirements may be for that machinery to be operated, there will be definitely some working capital requirements which will be freshly brought in because of this investment decision. So the investment decision making also brings in a working capital requirement. Are we going to estimate all those things? No, that is not our job here. Generally the working capital requirement will be given in the question. Our point here to note is we have to just estimate or actually use this number what is given in the question as far as its impact is concerned. So when working capital requirements increase, definitely they do increase when you are buying any new machine or investing in any new project. So whatever the additional working capital requirements, whatever working capital already is there, we don't worry about that. That has nothing to do with decision making process. But additional working capital requirements, how much they are, whatever they are, they have to be considered as an outflow first of all. Means at the beginning of the life of the project. Beginning of the life of the project, we call it as year 0. Will there be something called year 0? Nothing like that, but that is the denotion. Year 0 means now, we can say. Now is called as year 0. Year 1, 2, 3, 4, those are all future. That is future. So what has to be the treatment of this additional working capital requirements? It has to be treated as an outflow when in year 0. And after that nothing will happen. All the years it will be same. No adjustment is required. But at the end of the life of the project, because the working capital, which is additional working capital, which was required initially, now will be released at the end of the life of the project, whatever that is, year n, let us call it. N means the last year. In this case, let us say 5th year, it will be treated as what? Inflow. So in year 0, you take the additional working capital requirements as outflow, and last year you consider that as inflow. That is a treatment for working capital. So timing and direction both are important. Timing is what? Year 0 and last year. First 0th year, now also it is important, last year also it is important. But now how is it treated? It is treated as an outflow. Last year how is it treated? It is treated as an inflow. Of course, time value of money will not be same. We'll come to that part later. That's only just a multiplication aspect. But cash flows, once you build, then just multiplying that with the respective discount factor or PVIF and then totaling becomes only a clerical thing that can be dealt with later when we discuss about the techniques. That comes later. But point is here, building of cash flows itself has to happen in such a way that additional working capital requirements are treated as an outflow in the 0th year, in the sense now initial cash outlay. 0th year, whatever happens, that is called as initial cash outlay or initial cash outflow. This has to be treated as cash outflow initially, and at the end of the project it should be treated as a cash inflow. Simple. So this is the core point of treatment while building the cash flows. Initial working capital requirement should be treated as cash outflow, and at the end of the project its release should be treated as cash inflow. That's it. That is the treatment for working capital. That too additional working capital requirements, we can say. So that is one more treatment, important one while estimating the cash flows. Now one more point here, generally will be not very often asked, but still if it is there. For example, if there are any allocated overheads which are not related to this particular project, but they are related to the company as a whole. In general, the head office expenses or the corporate office expenses, those all will be allocated on some rational basis to various projects and various departments and various product lines. But are they related to this project exactly? No, directly they are not related. That is why they should be ignored. So allocated overheads, if any, they should not be considered as cash flows if they are not directly related to the project. Of course, if they are directly related to the project, if there are incremental overhead costs which will happen only because of the acceptance of this project, then they should be considered as cash outflows. Otherwise, just allocation of head office expenses, corporate office expenses, such kind of information, if it is given, that has directly nothing to do with this decision making process. That is why it should be also ignored. And sometimes there can be additional capital investment requirements. Normally, in general, initial cash outlay will be at the beginning of the project, which is year 0. When you say project or buying of an asset, you are incurring this cash outflow. So that is a negative cash flow. Outflow is going to occur. Initial cash outlay, that is called. Normally when that happens, it happens in year 0. Now, but is it compulsory that it should only happen at year 0? Not necessary. There is no necessity that always it should happen at the beginning of the project. Maybe a portion of that will be incurred in the beginning. Maybe it will be, it might be incurred even somewhere after some couple of years also. In such cases, we have to understand the timing of it. So we don't have to worry about that as a normal thing. Whatever the cash flows are given in the question, of course we should know whether it is outflow or inflow, and of course we should know whether when it is occurring, which year it is occurring. That is important. So point to be noted is there is no rule that initial cash outflows only will be incurred. Maybe there are some additional cash outflows also which might be incurred in future. For example, there may be a major overhauling that is required for the machine. Possible. After 4 years, maybe a major overhaul is required. A lot of cash outflow can happen then. Like that, maybe major repairs have to be incurred. Okay, major repairs we are talking, not the regular repairs. So those can also be incurred at any point of time. Regular expenditure anyway will be there. That is the part of the regular cash outflows. But even a capital outflow, capital investment, capital outlay can also happen in future also. Can happen. Not that every question it will have such kind of situation. If it is there, we have to just consider it as an outflow in the year in which it is supposed to happen. Simple. Direction is outflow, but which year it is happening, that we have to identify from the question. That's all. These are the key aspects to be noted while developing the cash flows. Timing and all will anyway come to that. If there are any additional capital investment requirements, not only at the beginning of the period, beginning of the life, even during the life also, if there is any additional capital requirements, that has to be considered as a cash outflow. Allocated overheads have to be ideally ignored if they have no direct relationship with the project. If there is a direct relationship with them, if there is an incremental overheads that is going to be incurred just because of this project, then they are relevant. Otherwise, they are irrelevant. Working capital is a very, very crucial thing. Almost in every question we can expect it. Not necessarily, but most of the questions will have it. How it has to be treated. The additional working capital requirements which will be resulting because of the acceptance of this project should be considered as outflow at the beginning of the project, inflow at the end of the project. Simple. Sunk cost should be ignored. Opportunity cost should be considered. So sunk cost is irrelevant. Opportunity cost is relevant. And depreciation has a tax shield, which is a very crucial aspect in the computation of the cash flows. That is the crux of overall aspects related to cash flows. Now let us go into little more details of when the cash flows can happen. Of course, they can happen at 3 phases. They can happen at 3 phases generally. Now, that is called, as we discussed, initial cash outlay. There will be, we can call it year 0. Let us say if there are year 1, 2, 3, 4, 5, just for example, let us say, during all these 5 years, there will be some regular cash flows, inflows and outflows, generally inflows. So these will be, we can call that as during the life of the project. Then, end of the life of the project, only at the end of year 5, there will be specially some more items which will be there. For example, something like scrap value of the asset, if it is sold, it has to be sold at the end of the life of the project, if there is any scrap value. like that the release of working capital what we have. So these special items might be there. We can call them as terminal cash flows or end of life cash flows. So these three phases of cash flows we have to identify. Now, which is year 0, during the life of the project, 1, 2, 3, 4, 5, including last year also, by the way. But last year there are some special cash flows which will be incurred or coming in, as the case may be, depending upon the data that is available. So those can be separately called as the terminal cash flows. That's it. What could be those items we can generally understand? Initial cash outflow or initial cash outlay. Either way it can be called outlay, outflow, both are same. So this is going to be generally incurred now before the project is getting started also. So what is that generally? Initial cash outlay. Cost of the asset, simply in general, whatever the asset you are purchasing, what is the cost of that? Installation costs also have to be added, setup costs have to be added. All the costs which are incurred before this asset is put to use have to be added. Simple. So that addition has to happen. Then additional working capital requirements, as we already discussed, that should be also added because that is outflow. This is also outflow. So we are talking about outflow here. So the total initial cash outflow is put together original cost of the asset that is going to be purchased, plus any installation costs, etc., which will be incurred while installing that machinery, plus additional working capital requirements, if any. Then we get initial cash outflow or initial cash outlay. That is one thing. Of course, if it is a replacement decision, then the initial cash outflow will have to be calculated differently. We will not come to that here because that is altogether discussed in a separate manner. We come to that replacement type of decisions later. Then we will discuss it. Otherwise, unnecessarily it will create confusion now. Let us simply talk about all the regular type of investment decisions, purchasing the assets. That's all. Fresh decisions let us take rather than replacement. Replacement, as it is a separate decision completely, and what are the intricacies of that, we can study them separately. We don't have to mix with others. So what is the general thing that let us focus on? So initial cash outflow is simply nothing but the cash outlay or outflow that happens at the beginning of the life of the project, consisting of the cost of the new asset, including any installation costs, plus additional working capital requirement, if any. This is the initial cash outlay. Then interim cash flows means during the life of the project. Interim means during the life of the project. Once there is any asset that is purchased or a new investment that is made, new project that is being implemented, naturally that will give some benefits, right? Some inflows will be generated by that project. Those all inflows will be the interim cash flows or life of the project. During the life of the project, what are the cash flows that have to be taken, that have to be computed according to the information that is given. Once again, for replacement decision, it is a little different. We'll come to that later. For fresh things, fresh investments, how it is. We know this already. One, profit after tax. Here, that is normally the accounting profit, we can call it. Add depreciation. We know that. Profit after tax, add depreciation is cash flows. That is the way we have to calculate the normal, regular cash flows that will generally be inflows, which will be coming into the organization during the life of the project. Of course, in each year, if at all, there is going to be any, again, further increase or decrease in working capital, if it is given like that, that has to be also adjusted. Okay. So, if at all, there is a decrease in working capital, it has to be added. Increase in working capital has to be deducted. So, decrease in working capital is a cash inflow. Increase in working capital is a cash outflow. You should know this from the cash flow statements also. That is logical wise. So, this is what is happening during the life of the project. In general, this item will not be there. In general, there will be only one additional working capital requirement that is given. We just treat it as outflow initially and we'll treat it as the same amount inflow at the end of the life of the project. During the life of the project, nothing to be adjusted if only this information is given. However, if each year working capital requirement is changing, increase, decrease, like that it is happening, then that adjustment has to be done during the life also, if it is there, which is very rare, but we should know if it is coming in the examination questions, we should know how to treat that. So what is the treatment of that? If there is going to be any fluctuation in the working capital requirements during the life of the project also, Decrease in working capital has to be treated as inflow. Increase in working capital has to be treated as outflow. That's it. So that is the adjustment. Rare but possible. Normally, what is cash inflow? Simple. Profit after tax plus depreciation. That is the during the life of the project cash flows, which is project cash flows, we can call it. So initial cash outlay is one thing. Project cash flows is one thing. Outlay, this is generally outflow. This is negative. Generally, this is positive because benefits are coming in. And then the last one are terminal cash flows, which will happen only at the end of the life of the project. That can be positive or negative. So these are called terminal year cash flows. Simply we can call them as terminal cash flows, which will occur when at the end of the life of the project. What kind of cash flows can be there at the end of the life of the project? In general, salvage value will be there. The asset can be sold if it is given in the question like that. So if the asset is going to be sold at the end of its life, there will be some salvage value. If there are any disposal costs, they have to be deducted. And we are talking about an inflow here. Salvage value is an inflow. Naturally, any cost related to the generation of that inflow has to be deducted from that. That is one thing. And the interim cash flow of the last year has to be also considered. This can be done in two ways. See, as I told earlier, year 0, then 1, 2, 3, 4, 5 separately. You just call them as initial interim cash flows or project cash flows. Then year 5 can be taken separately. One more time, no problem. What is the big deal in that? Or we can add these two and only take this full amount here as 5th year's cash flows, last terminal year cash flows. I would suggest it in an easier manner. Most of the cases, computations will be easier and clearer when you do like this. Initial cash outlay, project cash flows, terminal cash flows. Separate, segregated, so that there is clarity. We don't have to mix the last year's cash flows with the regular interim cash flows of that year. But both are same, right? If you have some cash flows here and some cash flows here, are they occurring at different times? No, both are occurring at 5th year only. You are showing them separately for simplicity purposes. If they can be added also, that's what is shown here. But another important point here, in the case of this final salvage value, when the asset will be sold, is tax treatment once again. Tax treatment means what? Here, the asset when it is sold, there may be tax capital gain or capital loss. Normally, again, you should not go to the Income Tax Act for the rates, all those things. No. Only concept you have to understand. When this asset, capital asset, of course, when it is sold, there is going to be either a capital gain or capital loss. One of them is going to happen. What is going to be the impact of that tax wise? If there is a capital gain, there is going to be a tax expenditure. If there is a capital gain and there is going to be a tax expenditure, means it will become an outflow. That is first point. If there is going to be a capital loss, there is going to be a tax benefit, and that is going to be an inflow. That's all. This is a concept we have to look at. Once again, you should not go to the intricacies of the income tax law. That is not our business. Here in financial management, only two possibilities are there when you sell the asset. Either there is a gain or there is a loss, or there is nothing. If there is nothing, there is no tax treatment required at all. If there is gain, capital gain, at the end of the life of the project, then there is a tax expenditure, which will be an outflow, separately to be treated. Or if there is a capital loss, that can give a tax benefit. So that can be treated as an additional inflow. That's it. So normally salvage value is one thing. That will be inflow. But in addition to that, there can be an outflow also, there can be an inflow also, according to whether there is a capital gain or capital loss. That tax treatment has to be done if that is given in the question. So whether it is a tax saving or a tax expenditure due to the sale or disposal of the asset, of course depreciation will be anyway there. All that tax benefit or tax expenditure will have to be adjusted at the end of the life of the project. That is one more adjustment to be done at the end of the life of the project. And as we discussed already, the release of the working capital, which was originally treated in year 0 as outflow, now should be treated as inflow. After adding all of them, these are the terminal year incremental net cash flows. Of course, here all of them are inflows. If there is any expenditure incurred in relation to that, that will be treated as an outflow. That means inflow will be reduced. So if we are very clear with the plus minus, that has to be very simply performed and simply executed according to the information that is given. If there is a benefit, it is an inflow. If there is a cost, it is an outflow. Net them off. That's all. That will be the net cash flow. But usually the terminal year cash flows will be inflows. And year 0 cash flows will be usually outflows, initial cash outflow. Then project cash flows during the life of the project, you can call them interim cash flows, or project cash flows is better word. Project cash flows are inflows in general. Sometimes there may be outflows also because there may be losses initially. We are not telling that every year it will be inflow, it has to be inflow. No, not like that. Concept we have to understand. We are not defining the problem. Problem will be problem. Whatever it comes, we have to just accept as it is. But in general, means in normally, that's what is the situation. Normally, we are talking about an investment decision. Investment means it requires an outflow initially. That will give some benefit later. So there will be certain inflows during the life of the project. End of the life of the project, usually there will be inflows. Why? Because there could be some salvage value, which will be an inflow. And release of working capital will happen anyway. That will be anyway inflow. So because of that, the terminal cash flows in general will be inflows. Again, in general, exceptions will not be there. There will be always exceptions. For example, you take a nuclear power plant which has to be closed and terminated, let us say after 15 years or 20 years, just for example. We are not going to do such questions. 20 years analysis we cannot do with normal computations. For example, if you take like that, a nuclear power plant project is going to be like evaluated as a project, and after 20 years it has to be dismantled. Example. Point is, at the end of these 20 years, we are talking terminal cash flows, there will be a lot of cash outflows actually. Why? Because to dismantle nuclear power plant, it is more expensive. No, nobody is going to buy that scrap value of that machines also may not be there. All are dangerous, toxic, radioactive, very, very dangerous to the health of the people also. So point is what? Such kind of very, very exceptional situations, toxic materials to be taken out of the project like that. In those situations, even terminal cash flows can also be outflows. There is a possible cost also that can be incurred at the end of the life of the project. But those are exceptions. Normally, normal assets will have some SAL value, whatever it is. That is scrap value, salvage value, whatever you can call it. That has to be considered as an inflow. And if there is any tax benefit or expenditure involved because of that salvage value, that is treated separately as an inflow or outflow. Naturally, common sense. Tax benefit is inflow, tax expenditure will be outflow, if any. But when the tax benefit and tax expenditure will happen, that has to be known. That is common point once again, which is capital gain or loss. If it is a gain, there is a tax expenditure attached to that. If it is a loss, there is a tax benefit that is attached to that. So that calculation may be required. That also is not guaranteed. See, all of them what we are learning, each of them will not be there in every question. But they can be there in any question. That is the point. Not in every question, but in any question. So we should know the treatment and we should know the concept of the treatment for each of these items. So very, very important. Once again, I'm telling you, development of cash flows, building the cash flows is the crux of this chapter. Applying the time value of money, multiplying with present value, interest rate factors. Those are all small things, clerical things. But cash flows have to be built very carefully. And that has to be done from the information that is given in the question, of course. We cannot have any preconceived notions there. However, information given in the question has to be processed carefully, computed carefully. For that purpose, we should know all these items. Every point that we discussed in the current class is a very, very crucial item. You should remember them very thoroughly. They are not some things which can be ignored. Suddenly, if some item comes, we cannot say, I forgot the treatment, etc. No. Every item has to be ignored very well. That is point to be noted. So that is the essence of building of cash flows. Some of the special items also we discussed. and 3 different time periods at which the cash flows might occur also we discussed. Initial cash outlay, project cash flows and terminal cash flows. Now some more points are there, generic points only. For example, let us say there is a depreciation point. So what are the tax shield of depreciation that we are looking at? We are having normally for the particular asset. In India, we have this concept of block of assets. Should we consider all of that? We don't need to consider all of that. Simply, we have to just take the depreciation rate and that particular asset as it is given in the question. Only if there is a special mention about block of assets, etc., if it is there, which is very exceptional, then only we have to take that into consideration. Otherwise, normally, as I told already, income tax act related items we should generally ignore. Normally. Why? Because we are not talking about only Indian context, it is generally international concept. However, questions may have anything. We are not the ones to design the questions. So what if the question gives such kind of things? Yes, then we have to apply it according to whatever is given in the question. So let us look at some example. Let us say A Limited acquired new machinery for 1 lakh depreciable at 20% as per the WDV method. 5 years life with the salvage value of 10,000. So what is the treatment of this? We can just compute the depreciation. Normally WDV method. What is that? Just taking 1 lakh as beginning point. First year 20% of that, WDV 80,000, on that 20%, then again WDV, on that 20%, then this, on that 20%, then this. So what is the book value of this asset at the end of year 4? Here we are talking about year 4 only here. That is 40,960. Then, when we are talking about, there is no other asset in this block, but it is the only asset. That is the general imagination we have to have. Otherwise, there will be a lot of other things which will also become complex. But in general, let us say this is the only asset which is there in the block. So here 40,960 is what is the WDV, which is there as a book value, right? But it is sold for 10,000 only. Means there is a short-term capital loss. And this is my point. Main point here is the short-term capital loss will result in a tax benefit, assuming the same rate of tax, that is 30%. One more point also, tax rates also, if tax rate in the question is given 20, 30, 50, 50, 40, 45, 35, whatever it is given, you just take that tax rate as it is. First point. Second point, you should not have application of income tax knowledge here. Normal tax rates are different. Capital gains tax rates are different. No, we don't need to. Whatever the tax rate is given, we have to assume that it is applicable for capital gains also, if nothing else is mentioned specially. Same tax rate has to be applied here also. So, applying that, there is a tax benefit here on this short-term capital loss. Short-term capital loss is not important for us. The tax benefit on short-term capital loss is important for us. So, what is going to be the terminal cash flows in this case? Let us say that is going to be 19,288 cash inflow. Why? Because there is a sale value of 10,000, which is going to be a cash inflow anyway, and there is going to be a 9,288 of tax benefit. Put together, the terminal cash flow will be 19,288, but not 10,000. So, end of the life of the project, terminal cash flows have to be developed like that. if we are considering the tax impact on that also. Usually, when there will be tax impact, we have to also keep that in mind logically. When the question has WDV, then only there will be tax impact at the end of the life of the project. Normally, when there is a straight line method, which is normally followed in most of the cases, in this case, there will not be much of tax impact. Why? Because already during the life of the project, you would have depreciated the entire asset, right? Already whatever the asset would have been, that would have been already completely depreciated. So after depreciating all of that, if there is any real scrap value, extra money, lot of extra money that is coming, that can result in capital gain, that might result in tax expenditure. But again, that is exceptional case. Only when there is a tax expenditure on the capital gain at the end of the life of the project. So, every question we may not have this tax impact or capital gain or loss at the end of the life of project. if it is part of the question, then we have to definitely treat it like that. Sometimes it will be specifically asked to ignore it. Then you should not say, no, I will take it. I'll consider it because it is correct. Yes, considering it is appropriate. But if the question says don't consider it, don't consider it. So ignoring the capital gains on the capital gain or loss, which might result at the end of the life of the project, can be an assumption also for many questions. If it is not ignored, it can be computed also. Either way, it is okay. But if the question clearly is expecting us to do that, we have to do that. If the question is clearly saying that ignore it, we have to ignore it. When the question is not clear about it, it is our choice. In general, we ignore that. If it is required, we can consider this tax benefit also or tax expenditure also on the short-term capital loss or gain, as the case may be. Now, if at all, let us say there is more than one asset that is existing in the block. This asset is sold. In this case, there may not be any capital gain or loss here. Only there can be tax benefit of depreciation. So here, sales value is there. Anyway, this is 10,000 and 30,960 is the WDV. On this, there is only depreciation. And there is a tax benefit on depreciation only. But the question is, what is going to be the impact of this depreciation on the asset that we are looking at? So that is the reason why we don't have to worry about the costs which are related to the other assets. The block of assets types situations are not much required. If at all, let us say there is a capital gain instead of loss. Let us say the asset is sold for 50,000 rupees. Then there is a short-term capital gain. Then in both the cases, there is a tax loss, tax expenditure on this short-term capital gain. So what is the essence of all this is? Same thing what we discussed. Short-term capital gain, if it emerges, that will result in tax expenditure, tax loss. This is the real cash flow. This short-term capital gain or loss is not important for us. The tax expenditure on that is important for us. If there is a short-term capital loss, then there will be a tax benefit on that. That only has to be considered. And once again, if we are looking at all the block of assets being invested at the same time as part of the investment decision, then only this will be relevant. Otherwise, only one asset if we are talking, we cannot think about all the other assets. How many assets are there in the block? Will this asset be having any scrap value? Or it also has scrap value, it is sold also, but it is not going to have any tax impact. All these things are imaginations and assumptions. That is why we don't need to do that. So for a simple understanding purposes, if we ignore the tax impact on the capital gain or loss on the sale of assets at the end of the life of project, that is probably with this logic of maybe this asset is not just a simple separate asset, it is already part of a block of assets. So it will not have any capital gain or loss involved here. Why? Because already a lot of assets are there. More than one asset is there in that block. Just by selling one asset, it doesn't have any tax impact. So keeping such kind of assumption also in mind, we can solve the questions. Mostly that's what happens. But what is this particular thing we are talking about? This has no impact on the particular asset. That is for the entire block. We have nothing to do with that. We generally talk about one asset. One asset means one machinery, one building or one particular project, starting a new branch, whatever. Only for that particular one asset we are looking at. All the broader things which are related to the entire company, which are related to the other assets of the company, we will not have any information about them. So when we don't have any information about them, simply we have to just ignore them. That's it. So more the information given in the question, then only we'll have more clarity. If it is not given, we should not be worrying that that information is not there, this information is not there. Unlike in real life situations where you know everything about the company, when you are in finance team, here you cannot have the entire picture. You will have only a portion of the picture which is given to you. You have to use that information and come out with the solution. That limitation has to be understood. That is one of the points to be noted. And as we already once again, I'm repeating this, 2 points have to be here noted. One of them which we discussed just now, exclusion of financing costs. So excluding of financing costs means Definitely, one of the financing costs is interest on the long-term debt. That should be ignored while computing the profits as well as taxes. That is first point. Second point, dividends also are irrelevant. So we are not talking about a financing decision here. So two things have to be kept separately. Financing is already done over, whether with the debt, whether with the equity, it doesn't matter. Whatever had to be done, already done. Money that has been raised is now being invested. So this is only related to future. This is only related to how this money is going to be invested, how the result of this investment going to be in future. That will be only looked at. What happened already in the form of raising the finance should be ignored. That has nothing to do with this decision. This decision should be on the basis of the merits of the investment itself, not on the basis of the sources of finance for that investment. So that is a big wall between these two that you have to understand. Though they are related with each other, but the financing cost definitely has to be ignored. What financing cost? Interest also and dividend also. Both of them should be ignored while taking these investment decisions. Another logic also is understandable because the topic has come. When we look at the DCF techniques, all the discounted cash flow techniques, we need a discounting factor. What is that discounting factor? What is that discounting factor? Present value interest rate factor. What is that amount? In general, that present value interest rate factor is going to be the weighted average cost of capital of the company. That is the basic bare minimum return that anybody should expect. Again, weighted average cost of capital computation is altogether a different topic. That is part of the cost of capital structure chapter as part of financing decisions. That is different topic. But whatever the weighted average cost of capital of the company, let us say 14%. That is the cost of capital of the company. Is it only cost of debt? No. Is it only cost of equity? No. Is it only cost of preference shares? No. It is all of them put together. Some computation has to be done so that we get weighted average cost of capital. How to do that is a different story. But that is going to be taken as the discount rate at which the cash flows of the project have to be discounted. So PVIF has to be calculated at that particular rate, though not 14%. That is an example. Weighted average cost of capital of the company. So the point is the cost of the debt and the cost of all the things, cost of equity, cost of preference shares, all of them are already considered in this. So you don't need to consider them once again in the cash flows. That will be double time computation rather than treating it duplicate computation. To avoid that duplication, we simply ignore the financing costs. Very, very important point. In the cash flow computations, we should not consider interest. We should not consider the dividends also. That's it. So that is the point to be noted. One of the crucial aspects. And when we ignore it, anyway, it is there already. So profit after tax, finance cost has to be excluded. That should be not taken into consideration. So whatever the profit before interest and tax is there, EBIT or PBIT, straight away from that tax has to be deducted. Interest, no, forget about it. We know there is interest, there is something and all that. But there is no point of deducting it and adding it and doing these calculations. No need of all this. Not required, simple. Just ignore it. Ignore interest. And take whatever earnings before interest and tax are there. Directly take tax on that. So you'll get profit after tax. Financing cost is excluded. But is that cash flow? No, it is not cash flow. We know that we have to add back depreciation. That happens later. That is one of the points to be noted. Another principle here is post-tax principle. Of course, tax impact has to be definitely noted. In each case, every time it has to be noted. So simple way, if at all we have to have a kind of framework for it, though it is not advisable to by heart it or remember it. For understanding purposes, this is what is the essence of what we have to compute in the form of project cash flows. First point, sales units, number of units, multiply that with selling price, you get total sales. Okay. From the total sales, deduct variable cost. Okay. From that you get contribution. Okay. From that you deduct fixed cost. Fixed cost, two types of fixed costs are there, cash cost and depreciation also. So cash cost also you deduct it. Depreciation also you deduct it first, no problem. What you get is earnings before tax. Where is interest in this? No. Nowhere there is interest. We have to just ignore that. So just earnings before tax is there. Deduct tax. You get earnings after tax. But then add back depreciation. What you got? Cash inflow after tax. That's all. So this is how project cash flows have to be computed. Simple manner. Will all the questions contain this type of requirement? No. But a comprehensive question with a lot of data can definitely be there, in which such kind of calculation might be required. We should be ready to do the biggest possible calculation also, and from the information available, we should be ready to do the smallest possible calculation also. It all depends upon the information given in the question. According to that, our approach has to be changed. That flexibility should be there. Now let us just simply go through one illustration to understand how the project cash flows are to be calculated. ABC Limited is evaluating purchase of new machinery with a depreciable base of 1 lakh rupees. Expected economic life for 4 years. Change in earnings before taxes and depreciation. 45,000 in year 1, 30,000 in year 2, 25,000 in year 3 and 35,000 in year 4. Assume straight line depreciation at a 20% tax rate. Compute the relevant cash flows. Such kind of questions will not be given in the exam. It's only for practice. Because we need to do this warm up before we go into the real computational aspects and analysis aspects of applying those techniques. But that comes later. Before that, we should know this building of the cash flows first. So how to build them? First point first. 0th year, there is 1 lakh, that is different. Leave it separately. That is purchase cost of the machinery. During the life of the project, how the cash flows are to be built. First year, second year, third year, fourth year. Okay. Basically, whatever the information given, you can take that. But most important is, what is that? What is that information? Earnings. This has to be read very carefully. Earnings before the taxes and depreciation. So tax is also not deducted, but depreciation is also not deducted. Okay, clear. 45, 30, 25, 35. Okay. 45, 30, 25, 35. $45, 30, 25, 35. These are the cash flows, not cash flows actually, profits. Before depreciation, before tax. First thing first, naturally we have to deduct depreciation. Depreciation, what was given in the question particularly, straight line method, 4 years, 1 lakh is a depreciable base. So simply, each year there will be 25,000 depreciation which can be claimed. 25,000 each year. This is the deduction, we can say. So, what is going to be the profit before tax? Before tax. 45 minus 25, 20. 5, 0 and 10. This is profit before tax. Then you have to deduct tax. Tax at what rate? 20% as given in the question. So 4,000, 1,000, 0, 2,000. 20% is the tax rate. Whatever tax rate given in the question, that only you have to take. No questions asked there. No income tax law to be invoked there. So what is profit after tax? That is what we are computing here. 16,000, 4,000, 0, 8,000. This is not cash flow. We want what? We want cash flows. We want cash flows means what we should do? Simple. Profit after tax plus depreciation. Depreciation already we have 25,000 each year, right? If it is WDV in the question, little bit of more calculations will be there. If it is straight line method, it will be straight away easily computed. But treatment is same. Profit after tax plus depreciation will give us cash flows. So what will be the cash flows here? 41,000, 29,000, 25,000 and 33,000. These are the project cash flows. 41, 29, 25 and 33. Okay, that is how cash flows have to be calculated. That is one of the crucial aspects in this entire chapter, building of cash flows or determination of cash flows or estimation of cash flows, we can call it. Various intricacies of that we discussed in the current session. Once again, I'm reiterating, this is a very, very important aspect. Even if you would like to repeatedly understand them, you can watch this multiple times or note down the crucial points, each of them, and treatment. What is the item? Treatment. Like that in your notes. That will be another way of revising it multiple times so that you don't forget the treatments. First thing, once you understand the concepts, there is no point of forgetting it. But when we face such situations in the examination questions, we should be very, very comfortable in solving them and dealing with them. So that is the first section or whatever part of this chapter, estimation of cash flows. Once this is done, remaining things are all techniques. What are the techniques? We know them already, names at least, payback period, accounting rate of return. These two are called non-DCF techniques, traditional techniques. And DCF techniques are time adjusted techniques, are those which consider time value of money are also there, like NPV, profitability index, IRR, modified internal rate of return, discounted payback. These are all DCF techniques. So these are all techniques, how to use them on the cash flows that are already computed is the next segment of this chapter. We'll discuss all those things in the upcoming classes. Till then, take care. Bye-bye. Thank you very much.